Ask me how many indicators and oscillators are available in the technical domain for study. There are 3,500 plus indicators and oscillators are available. So what is the indicator and what is the oscillator? So this we need to understand in the very beginning. So whenever we talk about indicator, it has a scale from 0 to infinity or 0 to 1 some cases, and reverse also 0 to -1. So this is some indicator. Some indicators have 0 to infinity and 0 to minus infinity. Some has 0 to plus 100 and 0 to minus 100 also. This is called your indicators. Oscillators, whenever we talk about, this is a scale of 0 to 100. So oscillators are from the 0 to 100 scale. So what it does here, every price of any financial instrument, if you take gold, it has a price. If you take bank nifty, it has a price. If you take nifty, it has a price. So certain companies are having a 2-digit number and certain are having the 3-digit number and certain are having the 4-digit number. So it is practically impossible to follow all these numbers in a unique form. Means it is not a 3-digit number, all prices are not 3-digit number, all prices are not 4-digit number, all prices are not 5-digit number. So for that, we have to statistically exploit that data without manipulating the data. We have to exploit the data and bring it to a form of 0 to 1, 0 to -1 or 0 to 100. So when we do that data manipulation and bring down that data to a more understandable form, that is known as your indicator or oscillators. So these indicators and oscillators also highly rely on your historic data. Previously what happened, based on that what we are expecting now. So that is called your statistical indicators. So whenever we talk about moving average, whenever we talk about indicator, whenever we talk about oscillators, these all domain is lagging indicators. Why? Previously something happened, maybe that past is intraday 1 minute candle, intraday 5 minute candle, or it is a daily price candle, or it is a weekly price candle. Whatever may be the reason, all prices are the historic prices, and from this historic prices we have to derive certain conclusion, and we have to say that yes, in future also it is going to follow the same way. That is what the historical indicators or oscillators say. But as a trader, your requirement is entirely different. Yes, now I am seeing RSI. So RSI is telling that okay, below 30% of RSI trend is oversold, above 70% of RSI it is overbought. Currently I am at, suppose till yesterday's price I have taken, or till some price I have taken, and I am saying that I am 69 now. So can I conclude this thing as a mature of the trend, or the trend is already over, it is on the overbought zone, and based on that can I sell it? So, or if I am at 35, shall I buy these things for a expectation of a 70? Because it is a historic indicator. So if you treat this historic indicator as a historic indicator, and if you say that yes, it is saying something on history, and if you rely on the history repeats again and again, then these indicators may not work perfectly for you. So as a trader, our aim, always focus on one factor: what is going to happen in future course. Next minute what is going to happen? Can I get some clue from these indicators? Can I get some clue, some information which will tell me that yes, in future this is going to happen? So when you are aiming to scale, or when your aim is to get the future information from these particular indicators and or oscillators, so we have to little bit modify those things for our requirement. So while modifying these things, we'll never change the RSI formula, we'll never change the Bollinger's formula, or we'll never change the stochastic oscillators formula. So these are the things we are not going to change. So what we are going to change here, the price part. We are currently at what price, and at what price we are going to change this thing. So what is our expectation? Again, while taking on those method of 1SD formula, while taking on your moving average concepts, basically we have three jobs to do as a trader. Whenever we are anticipating a future move, we need to know when the uptrend or downtrend will start. Uptrend or downtrend will give a reversal. Uptrend and downtrend will have a saturation. So these are the three things we require to be a successful trader. Our analysis have these three objectives. Whatever method you follow Fibonacci, Elliott, Gann, 1SD formula, you follow any of the method, your objective is confined into these three things. When my trend will start, when my trend will reverse, when my trend will saturate, means there onwards I may not move forward. Maybe I will take a pause, maybe I will go for a consolidation phase. That is your saturation point. So these are the three objectives always we need to identify in our analysis. So first I will be discussing on the RSI or Bollinger Band. So John Bollinger, when he has given this particular method, and you need to highly trust on this particular method, because this is only one indicator available in the domain of your 3500 indicator, which has taken the volatility as an analytical tool for its future expectation. This is only one means indicator which has accommodated the volatility. Other indicators, couple of indicators they have taken, but they have passively used that volatility. This is one indicator which has used the decision process or the volatility as an active tool. So what Bollinger has told here, so it has told that whenever the price moves, so you have, it has a upper band, it has a middle band, it has a lower band. So in this band only price has to move. So you need to calculate these bands. So he has formulated specific formulas for that. He has given that standard deviation, which is another form of a volatility, that you have to find out. First you have to mean standard deviation. If you are taking 10 days data, first using the 10 days data, you have to find out what is the average of 10 days. From every data you have to subtract this average, square it, divide it by 10, and this process you have to take a summation. So this will give you a standard deviation. So nothing but it is your volatility. Suppose that you have a formula for middle band. Middle band is nothing but your average. Then you have a upper band. Then you have a lower band. So these three things you have to calculate, and upper band is middle band added with 2 sigma, lower band is your middle band minus 2 sigma. So this is how you can get your upper band, middle band and lower band. Once you find out these three bands, then we need to take a trade decision. So what is the assumptions, or what is the rules he has given? So he has said that this is a 20 period moving average you can take to find out the middle band. You can change it to 3 period, you can change it to 5 period, you can change it to 10 period also. And this he also said that if the band contracts due to decrease in the volatility. So this bands having a nature that it has to be expand if it is in the expanding stage here, and it is a contracting state. So whenever the band contracts, you can say that decrease in the volatility is falling, and this is setting a trend for the future. And second rule what he has given, if the price breaks through the upper band, a continuation of the current trend is to be expected. If the price move in the above this upper band, then this uptrend is going to continue. If the peaks and hollow outside the band are followed by the peaks and hollow inside the band, a reversal of trend may occur. Means whenever the price move above the upper band but fail to maintain that, and again fall below the upper band, and that also doesn't maintain, and again it has moved above the upper band. If this tendency continues, then we can say that a reversal of the trend is expected. So the fourth point what he has said, that if the price movement that has started from one of the band line reaches the opposite one, the last observation is used for the forecasting the price guide of the post. Means whenever the price, if it is started from a middle band or a lower band and successfully gone here, so then from this price point only we can observe the next guiding post, means next move. And this is very important clause in this particular method. It is very important clause in this. So however, for calculating all these things, he has told that yes, everything we should treat as a historic data. We should take it as a historic data. So historic data, whenever we are taking, this indicator is becoming a lagging indicator. But here in today in our particular study, I'll be converting this historic indicator to a forward indicator, or an indicator which you can rely on, or a indicator which you can say that it is a forward indicator. So moving to this particular method. So for calculating this Bollinger band, so I have taken say from 7th September to this 5th October. Today what happened we are going to say. So I have taken the 3-period moving average. Though it is 20 period for a long term. So I have taken the 3-period last traded price of the Nifty here, which is my middle band. So here first I have taken the this thing, then I have converted to a exponential moving average. First one is be a simple moving average. Second onwards I have made it as exponential moving average. So middle band is my 3-period exponential moving average. Then Excel already having a formula to find out a standard deviation, STD EVP or standard envelope function. So using this one for this 3-period, we have calculated the band size. What is the band's width will be? Means you have a upper band, you have a upper band here, you have a lower band here. In between, how many price points will be there? So that already we have a ready-made formula available in the Excel, so that we have utilized and brought it. After getting these things, you have the formula for upper band and you have a formula for lower band. So here you are saying that they are using 2 times of your standard deviation. Since I have standard envelope function I have utilized, so there is no need of multiplying it by 2. I have just added these things, upper band by 100%, lower band by 100%. Means whatever the price point it has come in the from the middle band I have added, and from the middle band I have subtracted. So this is how I have got these levels. I have got these levels. So once we are going for this particular move, then we need to find out what proportion way we should take this study forward. So if you just take it here, So till 5th October, if I just say it here, till 5th October, when your closing was 8145, you are in the upper band. You are above the upper band. Our upper band is 8124. You have closed at 8145. So trend will remain same. Then you have a lower band. Lower band also, it is only subtracted. Now we have to devise a method to enter a trade. So there we have to take some clue from the previously available methods in Iliad's, GAN and moving average. So Iliad says that you have a 5 wave, 3 wave. So that ABC or 1, 2, 3, 4, whatever the name you are giving, it is entirely different. However, 5 impulsive waves and 3 corrective waves. So what is the impulsive wave? Means whenever greater demand will be there, that demand may be, or greater supply will be there. So that demand or supply should have a tendency to take the price to a 5 step above or 5 step down. That is called your impulsive wave. Impulsive wave is nothing but not, do not think that impulsive wave is only upside. Impulsive can also happen in the downside. So the move or the trend action will have that much of energy, that much of involvement by the trader, that it should move in a 5 step ladder. So this 5 steps has different rules and other things. Same way, Gann said that whenever there is a third trend line crossover happens, we should move, we should enter a trade. Moving average also, you have a 5 period moving average and means 10 period moving average. So these numbers 5, 3, 5, 10, these are the things is very common for us. So what I did here, if you have 100% of movement, so 5 occurs multiple times. So if I take 100% as my move, then I have just divided it by means 100 divided by 5, so 20% of move. That's why also Bollinger used the 20 period moving average. Why not 19? Why not 18? Why that is the 20 period moving average? Bollinger's original note says. So here the 20 is being derived because 100 is being splitted into 5 equal segments. Considering one impulse will have a 5 segments. Similar way, one corrective action will have a 3 segment. So 20 period and 3 period. So here I have taken the 3 period exponential moving average. I have derived the U band and upper band and I band. Now we need to move along with this particular concept. So what happens here? Once you get this upper band and lower band intact, now we have to move what happened for the day. So where we have opened up. So if I just go for the opening of the day, so opening of the day, so Nifty, I am just going to the nsindia.com. I am going for the derivatives and Nifty, and we have got a opening gap of opening today, and that was 8190, quite higher opening. Gap of opening we have got, and that was also 8150, 8190, 8190. So once I take this one, 8190, my upper band is still 8211, my lower band is 8025, and this is the opening happened, and middle band is 8119. 8119 is my middle band. These are the upper band saturation 8211, lower band saturation is 8020. So now my scalings will start from here. So how I should enter a trade here? Many other processes also you can implement here. 8119, which is your middle band, added with, you can say 20% of your price range, which is or your standard envelope divided by 100. So if I can add this 8137 price point works as a buy entry point for me. Similar way, if I take this same middle band 8119 and subtract 20% from this one, so this divided by 100. So this is my sell entry 8100 below. If it is falling, I will sell. 8137 above it moves, then I will buy. If I buy, so what will be my targets? So this 33% will guide me for that target. Added with this, multiplied with 33% divided by 100. So my first target will be 8149, or you can take some Fibonacci proportion also. So second target will be, sorry, I made a mistake here. So here my 8137 I have started. So my first target I will be taking from 8137. So 8168 will be my first target. Second target will be 8168 added with again 33% of 33% of your 93. So this is a 3 cycle you are taking. First cycle is over. Second cycle you are calculating. Second cycle also will 8198 level. Third cycle you will be having another 33% left out. So this added with 33% of your standard envelope range. So this is what we have got, 8229 level. So this is what we can get: 8137, 8168, 8198, 8137 above I should buy. And opening was 90, opening was 90, 8190, 8190. I changed it. I got this is the level. So I need to wait. If it never fall below that 8190 value below, then I am at second cycle. So let me wait for that 8198 to cross over. I can think for buying for optimum target of 8229. If it doesn't increase to that level, so I may think of buying at 8168 level, or I may think of buying at 8137 level. So 8137 will be a greater point for purchasing as per this particular method. Imagine you know the Bollinger's formula. Also you are following Bollinger. This is what it is coming. 8124 above, 8124 is your upper band, 7969 is your lower band, middle band is 8047. Currently price closed at 8145. You are saying that it is above the upper band? No chance is there. Today it has opened at 8190, no chance is there to trade. So if you treat Bollinger as a historic indicator and follow it as a historic indicator, many times 50% of your trading days you'll say that Bollinger never works. Bollinger doesn't give me the opportunity. Utilize any of the Fibonacci proportion, take the daily closing data, use any of the Fibonacci proportion. You can do a very good weekly predictions also using this thing. You can also utilize it for the BTST or sell today, buy tomorrow places. So whenever we are following the Bollinger's band, the middle band is act as your stop loss. If you are buying at if you are buying at particular level of 8137, then this will be your stop loss 8119. Or if you are selling at 8100, then 8119 will be your stop loss. Middle band will be your stop loss. So with this, if you can utilize Fibonacci ratios, it gives you great success. So here for intraday use, I have taken it for 3 period exponential moving average, and I have calculated the upper band and the lower band, and this middle band is taken from the standard envelope. So similar way, I am going to explain the RSI method, relative strength indicator. little complex, but you can able to do wonderful judgment there also. Similar way you can convert most of your indicators, whatever the 3500 indicators available, most of the indicators little thought put on their formulae, little lookout on their formulae. You can utilize those, most of those indicators you can convert to a forward indicator. So indicators are not lagging indicator. Indicators are always forward. We have to utilize it as per our need. So we can surely convert it to a forward indicator. RSI I will take. Before taking the RSI, couple of minutes you understand our product and services. And you are today with the second week's second day event you have joined. And today we are discussing about indicators and oscillators, and similar way you have other events also, third week and fourth week. So if you have not registered for the third week or fourth week event, please register. Registrations are still open. Regarding the products, Smart Finance has 10 products. Everything is having a different price tag. The part what you are learning, it is coming under our technical analysis course. And most of the softwares, we have intraday software, we have option trading software, we have option intraday, option positional, option strategy, all these things. So if you want to have a complete knowledge on different concepts, so the full package is coming at a discount price of 17,500. And this software for intraday positional as well as pair trade, which is our smart IT software, which uses our one standard deviation formula, volatility principle, and many more. It comes at a price of 8,500. So regarding any product related queries, you can call to our sales number 98403-48971 or 04464995823. So now I'll move to the RSI indicator, relative strength indicator. RSI stands for relative strength indicator. What it does here, RSI having a great number of formulas inside it. So RSI, you can first find out the first RS factor, then you have to find out the smooth RS and fast RS, then you have to find out the RSI. So normally what RSI says? RSI says that it is a scale of 0 to 100. 70% above RSI, it is known as the warning signal or a overbought zone. 30% below, it is considered as a oversold zone. And mostly we used to take 14 period RSI, 9 period also is being taken, and RSI also has specific patterns it used to form on this thing. So this is what RSI is, and it has a formula associated with that. RSI is 100 minus 100 divided by 1 plus RS factor, and RS factor you have to find out that average gain divided by average losses. Smooth RSI also has a formula, and other variation of this formula also present. So how we calculate here? So I have taken from 7th to 5th October the gain. Wherever it has given the gain, how many points gain it has given in the Nifty, I have plotted. How many losses points it has given, that also I have plotted. Then we have to find out the average. So whenever average loss 76 points, average gain 73 point, then I have to find out the RS. RS is nothing but the average gain divided by first RS. So average gain divided by average loss, then I have find out the RSI. So RSI says that 100 minus 100 divided by 1 plus RS factor, whatever you are getting, this is RSI. Imagine now it is 48.92. Nifty is at 8145. So suppose from 30 it has started, it is now at 48. So it has the tendency to go to 70. So if I can just change this last value, this is a trailing indicator based on the 8145. Imagine Nifty is coming to 8,100. So it is 47. So 7,900. If I check it, 37. If I take 7,850, so it is coming to 34. If I take 7,800, so it is 31. 7775, it is 29.5. You can say 7790. If I just last period price I am changing, I am saying that 7790 is my downtrend saturation point. So based on the RSI 7790. Same way, if I just go on adding here 78145, so I am telling that now 48, 8350, 55, 8450, it is coming to 58, 8600, so it is coming to 61. So I can say 8700, 70% if I am saying 8750, so it is telling to 64, 8850. Like this way, if I can go on changing, say 8900, wherever it is going, because just go on changing this thing. So 67, 68, 69, whatever the value you are getting here, say 67 level, we are saying that 8900 level, because one more data you have to add here. I have taken 5th October data, 5th October post also you have to add it here. So say this is the uptrend maturation point. Uptrend as per the RSI 8900, 7790. Downtrend maturation point. So currently you are at a specific point. So after doing this particular calculation, if you can from this downtrend, wherever it is mature, 7790, from here to 8900, how many points it is scaling? How many points it is scaling? So near about 1100 points it is scaling. So based on this 1100 points, taking the reference from 7790, if you utilize the Fibonacci proportion, then you can get a fantastic trend indicator for a long term view, for 15 days, for 1 month, for 1 week. Like you can get a long term view on this. So however, this may not work well in intraday basis. Intraday basis may not work. But after doing this particular things of your RSI factor, so if you just take the Nifty past 2 to 3 months data and start investigating its RSI on daily basis, like on 8th September, based on its trailing data, what was the RSI? So on 9th September, what is the RSI? So if you just see that 1 month's data, what is the maximum RSI it has given? What is the minimum RSI it has given? So from there also you can derive specific conclusion. It is not the hard and fast rule is that 30% is saturation, 70% is saturation. For Nifty, maybe saturation point will be different. For Bank Nifty, maybe the saturation point will be different. For a particular stock, maybe saturation point will be different. For gold, maybe the saturation point will be different. So for everyday basis, if you can get what was the RSI on 8th September based on its trailing 30 days data. So same way for minimum for 30 RSI, if you can get for the trailing 30 days, if you take 60 days data, trailing 30 RSIs you can get. Based on those RSI factors, if you can estimate where the trend saturates and where the trend matures, so then you can able to correctly predict the trend as per the RSI. So this is how you can utilize RSI as a forward indicator, not as a lagging indicator. So when you are at 8145, what is the RSI? So from here, if your historic values of Nifty says that no, RSI have never moved below 40, so then you can say that okay, 7900. So whether it is giving me 40, yes, 37. So whether 8000, so it is giving me 42. So I am saying that okay, 7950, because historically it has never been gone below 50. So my 7950 will be my bottom for this particular trend. And similar way, if I am saying that it has never gone above 55 in historical 30 days data, so I can say that 8450, whether it is giving me 55 or 8400 is giving me the 55. So you can say or 8,350 is giving me the 55. So you can say my now new level is 8,350. So you in this range utilize your Fibonacci proportions to get the actual levels where you can get a death zone, where trend reversal zone, what is a consolidation zone or anything. So you can use the Elliott also. So RSI also doesn't have a, never say that you should follow 30 and 70. You should not follow anyone, any other things. That never says. 30 and 70 is extreme case scenario is being followed by the RSI. However, that is not the only one rule for the RSI. RSI which is followed by every counter will be different. Any low volatility counter also it will have a very narrow RSI range. So based on that particular counter, what RSI it has followed in the last trailing 30 days, based on that if you can estimate the trend termination points and estimate your uptrend moves from the low 7950, estimate your downtrend moves from the high 8350, then RSI also works. So this is how you should utilize the RSI as a forward indicator. But RSI as a forward indicator may not work well in the intraday. So any questions?